If you open my portfolio right now, you'd see just 5 core dividend positions: SPYI, SCHD, VYM, Main Street Capital, and JEPI. I didn't pick them randomly, and I'm not chasing memes or hype. I picked them because together they give me something very specific: monthly income, long-term growth, and sleep at night stability. In this video, I'll show you exactly why I chose each one, how they're different, how much income they can realistically generate, and how they fit together like a dividend machine. Hey everyone, and welcome back to Yieldcraft, where we talk about dividend investing, US ETFs, and building passive income the smart way. If you're building a dividend portfolio or just curious what I actually own with my own money, make sure to like this video, subscribe, and let's just jump straight into it. Why only these 5? Let me start with a simple idea. You don't need 30 different ETFs to build wealth. My goal isn't to look diversified. My goal is to get paid consistently, grow that income, and not blow up my account. So when I built my dividend portfolio, I asked 3 questions. Will this pay me reliably? Will this income grow or at least stay strong over time? Does this ETF or stock play a unique role, or is it just a duplicate? The result of that filter is this core 5: SPYI, SCHD, VYM, Main, and JEPI. Let's go one by one and then I'll show you how they work together at the end. Let's start with the most aggressive income play in my portfolio, SPYI. This is the newest S&P 500 high income ETF. Why did I choose SPYI? Because it does something very rare. It gives me exposure to the S&P 500 and pays very high monthly income using options. Simple explanation. SPYI follows the S&P 500, but it doesn't stop there. It overlays a tax-efficient covered call strategy on the index. What does that mean in plain English? It holds exposure to the S&P 500, it sells call options on the index, it collects option premiums as income, it pays that out to me every month. Let's say SPYI's trailing yield is around 11 to 12%. If I invest $10,000 at 11.5% yield, that's about $1,150 per year. Divide by 12, around $95 per month. So just $10,000 in SPYI gets me close to $100 per month in passive income. That's one of the main reasons I hold it. High monthly cash flow without having to sell shares. But there's a trade-off. Because SPYI is selling call options, it caps some upside in the bull markets. It's not a pure growth ETF like VOO or QQQ. I don't expect SPYI to make me rich through price appreciation. I expect it to pay me month after month. That's why in my portfolio, SPYI is my income engine, not my growth core. Next up is JEPI, the JP Morgan Equity Premium Income ETF. People often ask me, if you already hold SPYI, why JEPI? Simple, they don't behave the same. How JEPI works? Conceptually, JEPI also uses a call option based strategy, but instead of writing calls directly on the index, it uses ELNs or equity linked notes issued by big banks. Each ELN is like a bond plus options package bundled together. JEPI buys these notes. Inside them, options are being sold. The income from those options is passed on to us as monthly distributions. On top of that, JEPI invests in a lower volatility stock portfolio, more defensive names, less tech heavy than the S&P 500. Where SPYI is more offensive, JEPI is more defensive. Lower beta, historically around 0.5 to 0.6. That means if the S&P 500 drops 10%, JEPI might drop only 5 to 6%. It still pays a strong yield, often in the 7 to 9% range. So if I put $10,000 in JEPI at say 8% yield, that's $800 per year, about $66 per month in income. JEPI gives me smoother ride plus monthly cash. That's why it sits next to SPYI. They balance each other out. Now let's talk about SCHD, the Schwab US Dividend Equity ETF. SCHD is not the highest yielder in my portfolio, and that's exactly why I own it. SCHD focuses on companies with strong cash flows, sustainable dividends, a history of paying and growing their dividends, solid fundamentals, return on equity, dividend history, etc. It's built for quality and dividend growth, not maximum yield. Real life perspective. Imagine SCHD yields around 3.5 to 4%. If I invest $10,000 at 3.5%, that's $350 per year, around $29 per month. Not very exciting compared to SPYI's roughly $95 per month for the same amount, right? But here's the key difference. SCHD's underlying companies are often growing their dividends over time. Payouts can increase year after year. The share price itself can grow with the businesses. SCHD is like the engine underneath the portfolio. It's my sleep well at night position that keeps compounding silently in the background. That's why I choose it. Not for today's yield, but for tomorrow's bigger, safer income. The next ETF is VYM, Vanguard High Dividend Yield ETF. If SCHD is my quality dividend growth play, then VYM is my broad high dividend backbone. Why I added VYM? VYM holds a wide basket of large cap US companies that pay above average dividends. I like it because it's very diversified. It gives me more exposure to many sectors: financials, healthcare, consumer, staples, etc. The yield is solid, typically in the 3 to 4% range. If I invest $10,000 at 3.5% yield, that's another $350 a year, or about $29 a month. How it complements SCHD. Here's how I think about SCHD versus VYM. SCHD focuses on quality plus growth of dividends. VYM focuses on breadth plus high yield within large caps. Together they form the core equity layer of my dividend portfolio. Less exotic than options funds. Lower risk of yield suddenly collapsing. Strong foundation around which I can add higher yield plays like SPYI and JEPI. The fifth position in my dividend portfolio isn't an ETF at all. It's a stock. Main Street Capital, ticker MAIN. MAIN is a BDC, a business development company. What that means? A BDC is a company that lends to and invests in small and mid-sized businesses, collects interest and equity returns, is required by law to pay out most of its income to shareholders. MAIN take that income and pays monthly dividends, plus sometimes special dividends. Why I choose MAIN? I choose MAIN because it has a history of consistent monthly payouts. It's focused on the real economy, actual businesses, not just indexes. The yield is attractive, often around 6 to 7%, plus occasional special dividends. If I put $10,000 into MAIN at 6.5% yield, that's $650 per year, roughly $54 per month. MAIN gives my portfolio a human, business-focused layer. It's not just the market. It's companies being financed, paid and managed. Now let's put it all together with a portfolio example. Let's say I structure my dividend portfolio like this: 30% SCHD, 20% VYM, 20% SPYI, 20% JEPI and 10% MAIN. And let's assume a $10,000 total portfolio first, just for easy math. SCHD around $3,000 at 3.5% will be $105 per year. For VYM, $2,000 at 3.5% will be $70 a year. SPYI with $2,000 at 11.5% will give me $230 a year. JPI with the same amount at 8% will give me $160 per year. MAIN with $1,000 at 6.5% will give me $65 a year. Total income $630 per year. That's about $52 per month from just a $10,000 portfolio. Now scale that up. At $50,000 invested in this mix, that becomes roughly $3,150 per year, or around $260 per month. At $100,000 invested, you're looking at roughly $6,300 per year, or about $525 per month. And remember, this is just income, not counting potential price growth from SCHD, VYM, and even MAIN over time. Let's be real for a second. These are not risk-free. SPYI and JEPI depends on options markets and volatility. Their yields can change based on market conditions. MAIN is exposed to credit risk in the businesses it lends to. SCHD and VYM are still equity funds. They can drop in a bear market. But here's why I'm comfortable holding them. I'm not betting everything on just one ETF. I'm mixing high income SPYI, JEPI, MAIN with quality and diversification. SCHD and VYM. I'm okay with shares fluctuating as long as my income stream stays strong and diversified. That's the mindset shift. I'm not just watching the portfolio value, I'm watching the income line. So to recap why these 5 made it into my dividend portfolio: SPYI, high monthly income from S&P 500 plus options. JEPI, defensive monthly income with lower volatility. SCHD, quality dividend growth and long-term compounding. VYM, broad, high dividend exposure to large caps. MAIN, monthly paying BDC with real business exposure. But here's something important. This portfolio isn't finished. I'm still learning, still watching the markets, and still researching new opportunities because a dividend portfolio is something you build and refine over time, not overnight. I'm planning to add a few more ETFs and maybe even a couple of individual dividend stocks in the future, especially ones that can increase my international exposure, add more monthly payers, and improve my overall income stability during low volatility market phases. Now I want to hear from you. If you could only pick 3 from my portfolio, which would you choose? Comment below. SPYI, JEPI, SCHD, VYM, or main. And if this breakdown helped you understand how I build my dividend portfolio, hit like, subscribe to Yieldcraft, and turn on those notifications so you don't miss the next deep dive. Thanks for watching.